I've used Warren Buffett's advice pretty much since the start of my investing career. I used a lot of his strategies to adapt to the Australian market, and that's how I came up with a plan in the beginning of how I would choose stocks, and even to this day I still use a lot of his advice. So in this video I'm going to go over some Warren Buffett advice that I still follow and that I think can help you with your investing career as well. So investing is a long game, and here's a quote I found. Our favorite holding period is forever, Warren Buffett. A lot of people know that investing is a long-term thing, but they still seem to get caught up in the weekly and monthly fluctuations of stocks, and it can cause a problem for some people. If you look at the stock market over any period that's more than, say, 10 years, you're going to see that the stock market always rises. Now, sure, there are years that the stock market is going to fall, but even in a crash, it usually takes about 2 to 3 years to recover from a crash or a fall. And that's why investing for the long term is crucial, because you can't focus on those weekly or daily even fluctuations. You'll go crazy. You need to be thinking about this as a long-term investment. Now, I've been investing for a number of years now, and I do believe that the thing that has grown my portfolio the most is time. Sure, some of the strategies I used to pick stocks, they probably were helpful in the beginning, but it was time in the market that really grew my portfolio. So investing for the long term really is key, which follows on to don't continuously trade. The Buffett quote I found, calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Oh, I love that quote. Isn't it great? Now, he's basically saying here that just because it's really easy to buy and sell on the stock market doesn't mean that you actually should. There are numerous studies that show that just buying and holding is a much better and safer, less risky strategy than continuously buying and selling. Now, not only is it a better strategy, you also are going to save money. You don't have to worry about brokerage fees, because every time you buy or sell, you are going to have to pay a brokerage fee. You also won't miss out on mass market rises, because no one really knows when they're coming. And I was guilty of this early in my career. I used to, if a stock wasn't performing well and I was just bored with it, I would get rid of it. And then in the following months or even a year later, that stock would go on to rise and I'd miss those rises. So taking a more passive approach and not continuously trading all of the time is actually going to be beneficial, which then follows you can't time the market. And the quote I found, you're making a terrible mistake if you stay out of a game that you think is going to be very good over time because you think you can pick a better time to enter it. Another great quote. The truth is, nobody knows how long different market conditions are going to last. They don't know how long a rise is going to last. They don't know how long a fall is going to last. So you can't be afraid that you're going to jump in at the wrong time, because there is no right or wrong time. The best time to jump into the stock market is when you have the money to do so. So no one can predict when the market is going to rise or fall. Here's the quote. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or even a year, I've never felt that I knew it, and I never felt that was important. Now, this does follow on from his last bit of advice. I think a lot of his advice does sort of fit together really nicely. Now, economists, they can see downturns in the general business market. That is something that can be measured, but that doesn't actually always predict whether a stock market is going to go up or down. There have been economic downturns where the stock market hasn't changed and it's actually gone up. Although a lot of times it does go down, it doesn't always go down. You can't predict what it's going to do. They can't accurately predict when a stock crash is going to happen. Economists have actually been predicting that the next stock market crash is coming. They've been predicting it for the last 10 years and it hasn't happened yet. And sure, it'll happen at some stage. Eventually someone's going to get it right. That's because market rises and falls really has a lot to do with investor behavior. Most market rises are because investors are jumping in and they want to buy, and most market falls are because investors are jumping out and they want to get out. So it's really people or investors that are actually causing the market to go up and down all the time, which is why it's really hard to predict what it's going to do in any particular situation. So it's just best to ignore it. So there's no room to get emotional in the stock market. The Buffett quote I found, some people should not own stocks at all because they get just too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. That's so true. People just get so caught up in the daily and weekly fluctuations, and we've already know that investing is a long-term game, so you should not be focusing on what's happening every single day with your stock. You can't be emotional about this. You have to just be very calm, very even, and think about it logically. Now, I know when it comes to money, not many people are logical, but in the stock market, it's imperative that you stay sane and just ignore all the noise and just focus on your long-term goals. If you are somebody that can't handle the fluctuations, then maybe an index fund is a good choice for you. Buffett actually recommends index funds to investors who don't want to think about what sort of individual stocks they've got, and I actually invest in a lot of exchange traded funds, which are just basically like index funds that you can trade on the stock market. If you want to know my recommendation, I particularly like the Vanguard exchange traded funds, or any of their funds. They're actually a pretty good company. But since other people are going to get emotional, you know that they are, you might as well take advantage. Here's the Buffett quote I found. During such scary periods, you should never forget two things. First, widespread fear is your friend as an investor because it serves up bargain purchases. Second, personal fear is your enemy. It will also be unwarranted. Investors who avoid high and unnecessary costs and simply sit for an extended period with a collection of large, conservatively financed American businesses will almost certainly do well. Now, we know Buffett is a value investor and he's a bit contrarian as well. Contrarian investing is where when everybody else is selling, you're buying, and when everyone else is buying, you're selling. Although he doesn't sell, he holds for the long term. So basically all of this point is don't follow the herd, don't get emotional like everybody else. If everybody else is panic selling, that is not a time to panic sell, and it actually might be a really good time to buy. I always say when the stock market falls, it's like a stock market sale, a company sale, where you can pick up some great companies at really great prices. So when the stock market recovers again, you can make some pretty good money. Just because the stock market falls does not mean that everything is over. You can't be thinking short term, you have to be always thinking long term. So during a fall is actually the best time to pick up some great companies if you have the money to do so. Again, don't wait for a fall. If you have the money earlier, that's fine. But if you have the money lying around when there is a fall, there's no harm in taking advantage. The next point he makes is that investing shouldn't be complicated. And this is something I totally agree with. The quote I found, the business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. It is so true. So many people seem to make investing so much more complicated than it is. When it boils down to it, all investing really is choosing a company, buying and holding. That is it. Warren Buffett's strategy is very simple. He simply looks for companies that he thinks are well managed and that are undervalued, and then he goes and buys quite a lot of it, as much as he can, and then he just holds for the long term, which is what we've been talking about anyway. Now, I used a lot of different strategies back in my early career. I was looking for things like return on equity above 15%. I was looking for earnings stability. I was looking for low debt, all of these factors. And while I'm sure they helped me choose some really great companies, it was time, like I said earlier, that really built my portfolio. So you just have to keep it simple. Even now that I'm a dividend investor, I always keep it simple. I just look for a good dividend yield, companies that are in the ASX 200 because they're the companies that have been around the longest and they have a higher capitalization. So I am just keeping it very, very simple, and I think it's worked well for me. His next point is to only make investments that you understand, and this one is key as well. In his Berkshire Hathaway letter to investors, I think it was 2014, yes, one of the 6 criteria that he looked for, simple businesses. If there's lots of technology, we won't understand it. This is another factor that I look for when I'm trying to choose a company to invest in. I have to know what that company actually does. So a lot of this you probably will already know. There'll be the banks that you use, the utility companies that you use. Maybe you go shopping for different retail products and you understand what those products are and so what the company does. I generally invest in banks. I generally invest in utility companies. I invest in things that I know, because if I understand the business, I can understand and then think about how that company is going to fare in the future. Like, banks aren't really going to go anywhere. Sure, people get upset with them every now and then, but they're going to be around. You can't see that a bank is going to fail. We hope not anyway. Same with insurance companies. I know what they do. Utility companies, I know what they do. But an example of companies I don't invest in is things like anything in the medical field. I don't really understand how that works, so I don't invest in them. That's not to say that any of them are good or bad stocks. It's just that because I don't understand the company, and they generally don't pay dividends anyway, they're just not companies that I'm interested in investing in long term. So this is about thinking about what you're going to invest in. It's more than just the stock code. It's actually a company, a business. People work there, people run it. That's what you're investing in. Which brings us to the next point, that buying stock in the company is buying part of a business. The quote I found, Charlie and I hope that you do not think of yourself as merely owning a piece of paper whose price wiggles around daily, and that is a candidate for sale when economic or political events make you nervous. We hope you instead visualize yourself as a part owner of a business that you expect to stay with indefinitely. perfect. Whenever you're investing, you have to think of yourself as investing within that company, as becoming a part owner. Investing in the stock market is a bit of a misnomer because you're not actually investing in the stock market. You're investing in a business. The stock market is just a marketplace where buyers and sellers come together. So saying that you're investing in the stock market isn't actually true. You're investing in businesses. I've always seen myself as a part owner, someone who receives some of the profits as a reward for investing in them. I actually like that feeling. Even if you're investing in funds, you're still investing in companies and you own a tiny small slice of quite a number of companies. So you still are a business owner, even though you have just a little stake in it. This is why a lot of people only invest in ethical funds, because they only want to be part of a business that's ethically minded, whether that's environmental or anything like that. It's just knowing what you're investing in, where you're putting your money. And that just makes investing more fun too. The best moves are often boring. The quote I found, "You won't have interesting cocktail party stories to tell about your boring companies like Procter & Gamble, maker of diapers, soap, toilet paper and toothpaste. However, companies like that are often the best in their business and thus can provide excellent long-term returns." And the stock market is best when you know that over the long term, your conservative, boring investments, your companies that aren't that exciting, they're going to grow over long periods of time. Investing really isn't meant to be exciting. It's just something that grows your money slowly over time. Now, dividend investing, what I do, is a particularly conservative, boring strategy because although I kind of find it fun every time I get a dividend check, I don't find that boring. But actually choosing the companies, very boring. I have a very conservative strategy. I barely sell and buy. I look in at my portfolio only once a year. The rest of the time, I just wait for the dividend checks to come. So don't think of the stock market as this wild ride, this roller coaster of ups and downs. Think about it over the long term. The boring, slow rise that's going to grow your money and your capital over time. Those are Warren Buffett's advice and the advice that I take into my own investing decisions. I really hope you found this video useful and it's helped you in your own investing career. Good luck and I'll see you in the next video. Bye.